Hey, welcome to The Explainer. Today, we're going to crack open the notebook from Joel Greenblatt's famous special situation investing classes at Columbia Business School. We're going to pull out some of the most powerful, practical lessons for any serious investor out there.
All right, so here's what we're going to cover. First, we'll start by tearing down a really common metric, EBITDA. Then, we'll build up a better way to think about price, figure out how to actually measure the quality of a business, and then walk through a really cool case study on spotting red flags. And finally, we'll wrap it all up with the mind state you need to be a successful value investor.
Okay, first up, we're taking on a giant. EBITDA is one of those numbers you hear thrown around all the time in finance, but as you're about to see, it can be seriously misleading.
So what's the big deal? I mean, what's actually wrong with using earnings before interest, taxes, depreciation, and amortization? Well, the problem isn't what's in the name, it's what it leaves out.
Okay, so this is where it gets really interesting. The key difference here is that EBITDA, well, it gives you a feel for a company's earnings after you account for the very real cash cost of keeping the business up and running. That's your maintenance capital expenditures. But EBITDA, it adds back depreciation, which basically pretends those costs just vanish into thin air. For a company with a ton of factories or machinery, this makes its cash flow look way healthier than it actually is. And this is a classic move to make a company look cheaper than it is, especially when debt is easy to get.
So if EBITDA is so flawed, what's the alternative? Well, Greenblatt's whole thing is to get you to stop thinking like a stock picker and start thinking like you're buying the entire business, lock, stock, and barrel.
And that's where EV to EBIT comes in. This is the big one. You've got enterprise value, that's the real price tag for the whole company, and you divide it by EBIT, its operating profit. So this ratio tells you, plain and simple, what multiple you're paying for the company's core earning power before you even think about taxes or how the company is financed.
Okay, so how do we actually calculate this enterprise value thing? It's actually pretty simple. You start with the market cap. That's what the stock market says the company's equity is worth. Then, and this is key, you've got to add in all the debt, because a new owner would be on the hook for that, right? And then you get to subtract any extra cash on the books, because hey, you could use that to pay off some of the debt immediately. So in this example, the real price tag, the enterprise value, is $600 million.
All right, so what does this actually mean in the real world? Let's run the numbers here. Say you've got a business with an EV of $500 million and an EBIT of $100 million. That gives you a 20% pre-tax earnings yield. Now, once the tax man takes his cut, that might be a 12% yield, which, if you translate that, is like paying an 8 times PE multiple. Now think about it. If you can get a 12% return from a business, when a super safe government bond is only paying you, say, 4%, that gap, that huge difference, that is your margin of safety. And that's everything in value investing.
But listen, price is only half the story, right? It's not just about buying something cheap. You want to buy a good business. That's arguably the more important part of the equation. So, what makes a business good? Well, the number one metric for that is return on invested capital. You'll hear it called ROIC. It answers a really simple question. For every single dollar the company puts back into its business, building factories, buying inventory, how much profit does it spit out every year?
And this is what that looks like in the wild. A great business has a high and sustainable ROIC. I mean, think about See's Candy, a brand so powerful, it's like it has this ever-widening moat around it. Or Coca-Cola, just predictably cranking out growth for over 100 years. A truly great business is just a cash machine. It gushes cash. A bad business, on the other hand, it just eats cash for breakfast.
Okay, let's put this stuff into practice. Because look, ratios are great. They're a good starting point. But the real pros, they know how to dig into the financials and find the story behind the numbers. So here we're time traveling back to the early 80s looking at Commodore computer. At a quick glance, you just see a bunch of numbers. Sales, receivables, inventory. Now, an average analyst might just look at these numbers in a vacuum. But what you really need to do is look at how these numbers relate to each other.
And boom, this is where the alarm bell should start ringing, loudly. In just 6 months, Commodore sales actually went down 9%. But at the same time, their inventory of finished computers, stuff just sitting in a warehouse, shot up by almost 82%. Sales are down, but inventory is way, way up. What on earth does that tell you?
This leads us to a super simple but incredibly powerful rule of thumb. When a company's inventory is growing way faster than its sales, that is a massive red flag. It basically screams at you to look closer and ask, okay, what is all this stuff they're making that nobody seems to be buying? And believe me, this kind of thing is not a one-off. A more recent classic example was Sunbeam. They were using this accounting gimmick called bill and hold.
So they'd book a sale to boost their revenue numbers, but the actual products never even left their warehouse. I mean, they were literally selling barbecue grills to stores in the dead of winter. If you were looking at the relationship between inventory and sales, you'd know something was seriously fishy.
So, all of this, all these metrics and red flags, they all feed into a much bigger philosophy. And when you look at value investing, there are really two main camps, two different ways of thinking about it.
First up, you've got the original gangster, Ben Graham. His whole thing was buying what he called cigar butts. You know, you're walking down the street, you find a soggy old cigar with just one good puff left in it. It's basically free, you take that last puff and you toss it. That was his strategy. Buy a company for so cheap, for less than it could be liquidated for, get that one last puff of value, and move on.
But then, his most famous student, Warren Buffett, took that idea and evolved it. See, Buffett figured out that, yeah, a cheap cigar butt is fine, but it's so much better to buy a truly wonderful business at a fair price than it is to buy a junky business at a wonderful price. Why? Because that great business will just keep growing and compounding your money for years and years.
At the end of the day, though, none of this works without discipline. It comes down to three key things. First, know what you know and know what you don't. Stay inside your circle of confidence. Second, always demand a margin of safety. Pay a price that gives you a cushion in case you're wrong. And maybe the hardest one of all, be patient. Have the discipline to just sit there and do nothing until a truly great opportunity comes along.
And that really leaves us with the big question, the one every investor has to answer for themselves. As you go out there and build your own investment strategy, what's more important to you? Are you on the hunt for that cheap cigar butt, or are you trying to find that truly exceptional business you could partner with for decades? How you answer that, well, that defines the kind of investor you're going to be.